Hi everybody, Jared Johnson here again. We're talking a little bit about today. We've been going through a lot of the different option strategies and so on. I want to talk a little bit about how to find the options that we want to trade, right? How to kind of find some of these numbers and get some good options that we want to trade. And there's a few things, there's a few major markers. Now you can use open interest, you can use volume, you can use a bunch of different things. A few things that I like to look at very specifically are number one, strike prices, and we'll talk a little bit about that. Number two, expiration dates. These two can be very, very telling about which options we should be trading and which options we should probably be avoiding. So what I want to look for when I'm looking at these different things, here's a couple of examples right here. Here's a small bank, right, that's publicly traded, ABCB, and what we see here is the stock is trading at $37.49, right? It's not a super cheap stock. It's definitely not super cheap. There's plenty of huge stocks that are trading for a lot less. This one's trading at $37.50, and look at the strike prices right here. This is very important. These strike prices will tell us a lot. For a stock that's not, oftentimes, just as clarity here, oftentimes if we look at a stock like Amazon, right? We'll just say Amazon. Amazon's trading at $3,100. That's an expensive stock. So naturally, we're going to have some strike prices that are a little bit further apart, right? $31.15, $31.20, $31.25. So we have strike prices that are about $5 apart. But that's normal for an expensive stock, right? Apple's a little cheaper, but still, $123. And you can see strike prices are about $1 apart, $123, $124, and so on. But we look at this little stock here, ABCB here, and it's trading at $37. And look at our strike prices. They're $2.50 apart in some cases, and in some cases they're $5 apart. And this is just at the next expiration a week out. We don't want to see that. Number one, we want to see something that has a lot of expirations. Number two, we want to see something that typically is 50 cents to $1 apart on the strike prices. So I'd want to see $22.50 and $23 and $23 and $23.50, or 22, 23, 24. This 22.50, 25, 30, 35, 40. That's no good. That means that this is a lower volume stock and the options are lower on the volume as well. It's going to behave terribly, most likely. It's going to be hard to get in. It's going to be hard to get out. We don't want to trade those. So number one, make sure that your strike prices are very frequent, right? They need to be 50 cents to $1 apart. Unless, of course, once again, you're trading very expensive stocks like Amazon or Tesla or something, and they're $2.50 to $5 apart. That's fine. But when these are stocks that are under, $100 a share, they should be about 50 cents to $1 apart. Now, 50 cents will be for the cheaper stocks, that are kind of in that $30, $40 and below area. Above that, they should be $1 apart. And that's going to tell us a lot about the volume of the stock and about the ease and ability that we'll have to get in and out of these trades. So make sure 50 cents to $1 apart on the strikes. And make sure that there's a lot of strikes. You don't want to see this right here, right? I mean, yes, that's going pretty far away, but that's going far away quickly because these strike prices are so far apart. $5 apart for a cheap stock, not good. In contrast, look at another bank. This is Bank of America. Most of you guys have probably heard of this one. The stock is actually trading for a little bit less money, about $10 less a share, but it's still an expensive enough stock. And you can see all of our strike prices are 50 cents apart, right? And there's a bunch of them, and they go in all directions. We have a lot of strikes, and they're close together. That's what we want to see. This right here, we don't want to see. This is the kind of stuff that that we don't want to see, right? We don't want to see strikes that are far apart and not very many of them. So that's thing number one. So this is our strike prices, $1 apart, 50 cents to $1 apart. That's thing number one. Number two, we want to make sure that we're trading options that have weekly expirations. That's going to be another great indication of option volume. So options that have a good amount of expirations is going to be super important. Look at this once again. This ABCB. The strike prices are terrible, and also look at our expirations. We have an expiration in 8 days. The next one after that's in 36 days. The next one after that's in 127 days. That's terrible. We don't ever want to trade stocks like this. We want to make sure that stocks have weekly expirations. So that'll be super important. Weekly expirations. That's what we need. We got to have that. And that's going to be super important for, again, finding stocks that are higher volume that can get us, in and out with ease and that will function well. So again, when I see these expirations, one next week, one in a month, one in, 6 months or whatever, not good. We don't want that. And again, in contrast, I go back to Bank of America here. Look at my expirations on Bank of America. There's one in 1 day, 8 days, 14 days, 21 days, 29 days, 36 days, and so on. So I want a lot of strike prices close together, and I want a lot of expirations, right? Close together. Weekly options. We need weekly options. That's going to give us some good flexibility, and that's going to keep us out of these stocks that are hard to get into and hard to get out of. One of the reasons we want strike prices that are closer and multiple expirations is because oftentimes we're going to end up owning the stock. And if we own the stock, we want to be able to sell options on it. And it's hard to sell options if you have these big gaps between strike prices and you have these big gaps between expirations as well. Doesn't give us the flexibility we need. In fact, it doesn't give us hardly any flexibility at all. And that's terrible. We need flexibility. So those are two very important things. Strike prices, 50 cents to $1 apart. Expiration dates, we need weekly expirations. We want something expiring every single week. Number 3, and perhaps one of the most important things, is going to be the option spread. Now, the spread, this is going to help us find some of the things that we want to, some of the options that are going to be best traded. Just like we need strike prices that are close together, we need expirations that are frequent, and we need a spread that is not going to be killer. So let's just look at an example here. Let's go back to our A, B, C, B. It's kind of a funny one to say, A, B, C, B. So we go back over here. Now, what I'm talking about when I'm saying our option spread is this, right? If here's the stock trading at $37, I want to buy a $35 call option 8 days out. The spread's not terrible, but it certainly isn't great. And by the spread, I mean the difference from your bid and ask price. You can see right here, my bid price is $240 and my ask price is $290. That's 50 cents apart. That's terrible. That means that it's going to be a little tricky getting into that, and it's going to be a little terrible getting out of that. So big spreads are not our friends. Look over here, same thing. If I buy a put at $40, because I think the stock's going to go down, my spread is $245 and $310. Again, we're in that 50 plus cents. That's a big spread. I want to see spreads that look a little bit more like this. This is going to help me find and see, stocks and options that I want to trade. Look at Bank of America. If I buy a put that's just about at the money, look at my bid and ask price, 81 cents and 83 cents. Now the stock's a little bit of a different price here, and much more expensive stocks can have larger spreads. That's normal. But right here, this is 2 cents apart, right? This is 2 cents apart. If I want to buy an option over here, a nice in the money call option, a couple weeks out, 120 and 122. So the tighter the spread, the smaller the distance between your bid and ask price, the more easily we can get into this trade and the more easily we can get out of this trade without having to throw a bunch of money away to broker commission stuff. So, again, if you go to a really expensive stock, Amazon, for example, if I want to buy, Amazon's trading at just about 31.10. Let's say that I buy a 31.05 call option. Now, you might be saying, well, look at this thing. It's almost $1 apart, but the option also cost almost $8,000 to buy, right? Most of the options we're looking at are going to be a couple $100. So this is a very expensive option on a very expensive stock, so it'll have a little bit of a larger spread, and that's okay. But on these stocks that are trading for much less money, like Bank of America here, we want to see very small spreads. So these are going to be some of the things that we need to watch for when we're determining which stocks we want to trade and which options that we want to trade on those stocks. Smaller, the better, right? So smaller is much better on these spreads for just a regular option trade, right? The bid and ask price. We want to make sure that is a big factor. So these three things will help us to find stocks that we want to trade. Strike prices, super important. Expiration dates, super important. Option spreads, super important. I hope that's helpful in determining which options you want to trade and which stocks you want to be trading. Thanks, everybody. Good luck, and on to the next one. Take care, guys.